Hey guys, it's Kory again, back from the LG channel. I really do appreciate you guys checking me out. I'm the latest YouTube personality, and if you haven't yet, check out my other videos or please subscribe to the channel. I do appreciate that, of course. That's why I make these videos for you, so if you subscribe, you'll get to see more videos, right? Today I'm going to talk about investing. If you know my channel, I talk about a few different things: real estate, health and wellness, IT and career growth, general motivation. And today, like I said, I'm going to talk about investing, but specifically bonds. And the title of this video is do should I have bonds in my should I invest in bonds? That's what I'm going to title this video. And that question is again somewhat loaded, but the answer is going to basically depend on how risk averse you are. If you don't know what risk averse means, then you should look that up. But it basically means that you don't like taking risks. You're very conservative with investing in money, and maybe you haven't even ever invested in anything besides a bank account, right? That's a very risk averse person. Okay, so a very risk averse person, if they go to a financial advisor, likely that financial advisor is going to recognize it and push them towards an investment in bonds. Okay, bonds are for people who are risk averse. That's who they are for, or for people who don't need high growth or aren't looking for a higher growth option in their investing. Okay, right? So, if you're a young guy, a millennial, or a young person, why would you own bonds in your portfolio? Right? And maybe you're asking yourself, well, shit, I don't even know if I do own bonds. Well, here's a good way to find out. Look at the S&P 500 or look at the Dow Jones Industrial Average over the past year to date and look at the average return for that. Right now, I don't know, it's like 8% maybe or 7% for the S&P 500. If your portfolio and what you're invested in, and you probably maybe don't know, if you don't know what you're invested in, maybe it's like a Fidelity Target Retirement 2040, or it's a Schwab Freedom Fund or something. You need to find out what you're invested in. You need to find out what the allocation of your investments is in bonds, okay? If you don't know what asset allocation is, guess what? I'm going to make a video on asset allocation, and in that I will explain what it is, but read up on it in the meantime, or click that video for sure, because you're going to want to see what you're allocated in terms of your assets to bonds, okay? So typically assets you could have are bonds, stocks, mutual funds, index funds, electronically exchange traded funds, ETFs, certificates of deposit, CDs, and then bonds, right? Well, bonds basically are municipal bonds, corporate bonds, or even government bonds, okay? So there's going to be high yield bonds and there's going to be low yield bonds. But even the high yield bonds are not going to produce enough growth if you're a young person in your 20s or 30s to get you to retirement. Okay, if you have a long time horizon between now and when you actually retire, so if you're like 20 and you aren't going to retire till you're 50 or 60, that's 30 to 40 years at least that you have to retire. So you should start out being somebody who has an appetite for risk, and is risk prone, basically. Take on additional risk by do not get bonds. Okay, do not invest in bonds. I'm 100% equities. I'm not even gonna lie. I do have a little bit of cash, but it's like 1%. It's like less than 1% in my portfolio of cash because I just don't need cash. Cash is not gonna make me money. Okay. Bonds are not going to make me enough money. So when I get older and I'm worried about a market downturn, bonds might protect my billions and millions of dollars, right? But when you're young and you're just growing your nest egg and you're in the growth and growth phase and accumulation phase of your investing, bonds are a bad idea. Okay, I'm going to tell you straight out, unless you can time the market or something and realize that, hey, oh, stocks and equities are crashing, and I better move my investments to bonds. People who did that in like 2007, 8, and 9, and then moved back into equities when the equities were at the floor and they bought low, they probably got a good 30-40% discount in equities. But you can't do that. You can't catch a falling knife, okay? I'm going to talk about what is catching a falling knife, or some sort of video on catching a falling knife. But it's basically timing the market. You can't drop a knife and catch it. Maybe you can get lucky once and not get caught. But the more and more you do this, you're going to get caught, right? Guess what? Not only do you need to know when the stock market goes low or before it's going to go low, so you can sell your equities if you're timing the market and trying to catch a falling knife, but you need to catch a falling knife twice then by timing when to get back in to before the equities go back on the rise, to readjust your assets and allocation from bonds back to equities, okay? So you've got your stocks and your bonds, and you're playing the risk of, well, the market's going down, whatever. Don't time the market. You can't. You can try, but you're going to get burned, okay? You'll learn your lesson. Investing is the slow, it's a long game, right? You can be aggressive in business, and you can be aggressive in investing in other people's stuff, but like the stock market, this is a long game, okay? You're going to be in it for 30 years. If you get lucky, if you're taking risks and going 100% Apple stock, Google stock, all techs, and there's a bust, a bubble bust, you're going to take a hit bigger than somebody that had bonds, okay? It's just how it is. People that had bonds, they're more risk adverse. So they're not going to take that hit, right? Now, if you're later in life and you're getting closer to retirement and you're like, wow, I really don't want to face the reality that we could face a pullback or a bull market and a correction of over 10% drop in the markets, or maybe even a 50% reduction, like bonds could help you minimize that risk, so that if you're allocated to like a 50-50 bond stock portfolio, and the stocks take a huge hits but the bonds don't, right, you're not going to lose as much money as if you were 100% stocks. So it's a good idea to look into bonds when you get older to see if that's an option for you. Now, I'm not saying bonds are going to be an option for all people approaching retirement, because that's not true. Again, it's for people who are risk averse. Risk adverse people like bonds, okay? And if a risk adverse person walks into a Charles Schwab or Edward Jones or whatever, they're going to put a portfolio together that includes some bonds, because that's the key to the investment advisor to say, if we don't want a lot of risk, then we don't want them coming to us saying, why did I lose all my money on stocks? What had happened? When I'm going to say, well, you didn't. You lost some of your money on stocks, but guess what? We had these bonds and, part of your allocation, so you didn't lose all of your money. We were risk averse, and that pullback didn't affect you. But guess what? What's happening is, what's the downside to that strategy? You're losing out on the opportunity. You're taking a haircut. You're losing out on 7 to 10 to 30% gains yearly. Average annual 7% gains. Bonds are going to do 2 to 3% maybe, and that's not even almost enough to keep up with inflation. If your goal is to keep up with inflation, if you have all bonds in your portfolio, you're not going to make it. You're not going to keep up with inflation. You need to have some equities and some exposure in your allocation to equities. So some people who are approaching retirement go to 70-30 stocks, bonds, asset allocation. And then we'll slowly, gradually, over maybe 3 to 4 or 5 years, as they retire, switch to towards their retirement date, get down to a 50-50 allocation, so that if the market crashed literally the day they retired, and they needed to take money out to live on, and that they would still survive in the future. Okay, so there's some strategies around asset allocation, and I won't get into them this video. Like I said earlier, check out that video. Rewind if you missed it on asset allocation, because I'm going to talk about some good stuff there, and then get into investment mixes and stuff, because that's all very, very important, and very important for your financial success. Okay, like if you don't know what you're doing with your money, and maybe you're like, oh, my husband does that, or my wife does that, or my brother-in-law manages it for me, like, you should be informed enough so that you can teach somebody else. If some Joe Blow or your neighbor comes over and says, man, I've never invested in my life, I would like some tips. You should be able to, and you should be able to educate them and not say, you know what, I don't know anything, my brother-in-law's doing it. That's crazy. Are you going to let your brother-in-law manage your money? Millions and millions of dollars in the future? What are you going to do when your money grows? And you're basically cornering yourself by saying, I don't want to know how my money's doing. I just want somebody else to manage it. That's probably not a wise idea. If you're a financial advisor, guru, whatever, argue with me all you want, but they're going to charge you a fee. They're going to take a big cut on something that you can literally do yourself. Okay, DIY. If you haven't checked out my DIY video, I'm going to tout that. That's the second or third video I tout here. But it's important. Do your investing yourself. Do your taxes yourself. Plan your workouts yourself. Like, motivate yourself. Fix your own car. Fix your own stuff that breaks. Make your own stuff. Be creative. Like, get creative, you know. But when it comes to investing in bonds, that's basically what it is, okay? Bonds are risk averse. They're not for everybody, and certainly not for people who are in the accumulation phase like young investors, okay? I hope those tips helped you. If they haven't, I'm sorry. If they have, great. Please subscribe to the video below again. And my channel, the LG channel, Life is Good, Life is Great. LG, baby. I want to motivate you guys. Just, look up an inspiring quote. Like, you miss 100% of the shots you don't take. So, like, take a shot, like, figure out what you're doing with your money. Figure out what your company is doing with your money, like, that you're working for. Figure out your pension. Like, figure out the formulas. Do the math. It will be a wise choice for you guys to know what your money is doing, okay? I can pull up my spreadsheet and tell you what my net worth is. I can tell you what my asset allocation is. I can tell you the fees that I'm getting charged to manage all my money, and my expense ratio for the entire portfolio, and my clients' portfolio. Like, it's all there accessible because I've tracked it, right? So beyond just bonds and stocks, and if they're a good idea, track your investments and know what you're putting your money into, okay? That's a good idea. Just track your investments. Use the Google Sheets, or use the software that comes with your investments, but know how to use it. Don't just be too scared to never log in, right? I used to be that investor that never logged into my account because I didn't know what to do. I was so scared that I would do something wrong. And this is from a guy that, like, knows IT and knows software and has invested in real estate. And I've had businesses at this point. And I decided, it was when I got married that I was like, I need to figure out how to manage my money. There's two things that I need to leave you with as a tip, and I'm gonna tout these in other videos. And this is the biggest advice I would give to somebody to say, Kory, if you could give me one of the best pieces of advice ever for investing, what would it be? Besides for saying dropping your financial advisor, it would be to start sooner and invest more often. Okay, invest sooner and more often, so that the frequency is better. You're investing more sooner. Time compounding is ridiculous. So the more you can put in, the sooner you can put it in, it's going to compound even greater exponentially than if you put it in later. If you got a bunch of money sitting in cash and you're like, when should I put it in? Today. Open the account, fund the account, and put it in an investment today. Okay? Hopefully this video is helpful for you guys. I'm running up on my time. If you have any questions, again, please leave them down in the questions. I will certainly answer them. I am a whiz at this stuff. Like I said, I have multi-millions of dollars under my management. And that's just in investments. That's not talking real estate. I don't even know how much. I'd have to add that up. I don't keep track of all the real estate as well as I do my investments. But the real estate grows good too. That's a great investment. So if you haven't checked out my real estate videos, check that out, because basically my real estate, after all the overhead costs and expenses of running the business, is a 6% annual return, and that's great, plus a tax deduction. So it's right there with the market, but the stock market's better. So if I had a video that said which is better, stocks or real estate, you decide. Thanks for checking out my video, guys. LG!